Information shared on the following program is for general information purposes only. It does not constitute legal, tax, investment, or other advice, nor is it intended to recommend any particular investments, products, or financial instruments. Always seek advice from your financial advisor, attorney, or accountant with regard to investment, legal, or tax questions.
What is your money really worth? Stay tuned to find out.
Welcome to the only show in the country dedicated to helping savers worry less about money, the Worry-Free Retirement, with your host, Tony Walker.
If you got it, you don't need it. If you need it, you don't got it. You don't get it, shame on you. Funny, funny, funny what money can do. Them that have it, get more of it. The less they need it, the more they love it. And it sticks to them like glue. Funny, funny, funny what money can do.
So now we are officially 20% below the recent highs on the S&P, closing in bear market territory. Ed, what's your advice to investors?
Well, I think between now and year end, there isn't much left here. We're probably going to continue to see this downward pressure. There is a lot of year end selling going on. You know, people have accumulated lots of profits in this bull market, and I think with the sell-off that we've had, they'd like to keep as much as they can.
A government partially shut down, markets tanking. There was chaos here too. The shortened trading day was a nightmare before Christmas. The 653-point drop adding to the worst month since the 2008 financial crisis, and adding to the ire of a president fixated by the stock market.
Well, that was some Christmas Eve, wasn't it? You and Martha, you're just sitting there getting ready to hang stockings up on the chimney, and all of a sudden your stocks are going down the chimney and hopefully not into flames. You know, this past December's free fall of the stock market will go down as one of the worst, not the worst, but as one of the worst stock markets as far as December goes since 1931. So with that little reminder that nobody can time the market, how many times do we have to remind you this, folks? Nobody. That's why we put those so-called experts on there. Nobody can time the market. So it really does beg the question when we go through these periods of what we call volatility. We got to ask ourselves, what is our money, my money, your money? What is it really worth? Welcome, folks, to the Worry-Free Retirement, and I am your host, that little man in a sweater vest, Tony Walker. And for about the next 28 minutes or so, I'm going to toss around out there this notion that this could be, I know I'm with America's favorite financial sidekick, Aaron, and his sidekick, Matt. I know he's heard me say this, but I mean this. This could be one of the most important shows I've done in a long time, because even myself as an advisor, I admit this, when we go through these downturns, these rapid downturns of the market, which we saw this past December, incidentally, we're recording this show on January 2nd, 2019, so Happy New Year. By the time you catch this show, it may already be a little past that, but Happy New Year indeed. But anyway, as we think about what happened, what transpired in December, it reminds me that most people really don't have a clue what money is worth. And this stock market and these experts trying to explain why it went up and what it's going to do in the future, again, remind us, folks, that nobody really does have a crystal ball. We also got to, I remind myself, I have already changed some of our portfolios. We're big in annuities, and we're going to get to our second show on annuities. We're going to be talking about fixed interest annuities today. If you caught last week's show, we were talking about variable annuities. So we're staying with our theme. We're going to be covering the 4 types of annuities. But I just felt like with this recent downturn, it's going to tie in very well to the annuity segment I'm going to do. But we have to remember that you as a saver, again, my granddad as a saver never owned a stock in his life. He didn't have a 401k. He wasn't exposed to stocks. There wasn't anything like the internet back then, so you couldn't just get online and start doing all this trading. So if you're a saver, you're putting yourself in a dilemma because you've got access to all this stock market, and you have to come back, and so do we, as your advisor, and say, wait a minute, let's slow down a minute. How much of this money, if any, this is where the pundits on Wall Street don't want to hear this, but if any, should we even be putting in the stock market? And for the vast majority of consumers, at least the ones that I meet and really don't understand money, the idea of what this dollar bill is worth has to be understood. Because what we're going to find out as we dive into this show in more detail, most things, I don't even care if it's annuities or even money at the bank, most things come with it a cost. And the real value of that dollar you think you have is not what it's worth at all. Again, last week we talked about annuities. In the next segment, we're going to talk about annuities and where they fit into what I call the risk timeline or risk continuum of what is risk and how much is your money worth. So before we get into the next segment, let's just talk about worth, and more specifically, net worth. You've probably heard that term. Aaron has, not to get into real specifics, Aaron, America's favorite financial sidekick, you got the grandfather clock squared away, right? So he inherited a grandfather clock. He got that working. And before we went on the show, I said, hey, Aaron, do you own any stocks? And he said, well, I haven't up until the recent death of one of my loved ones. And not only did I inherit a grandfather clock, you inherited, what was the name of that stock? Duracell. Now, actually, I bet that stock's gone up with Christmas. How many batteries you think are bought at Christmas? But anyway, so Aaron now owns a stock. There's an old story I heard about this, Aaron. There was a preacher that didn't own any stock, didn't believe in stock, never worried about money, and apparently this preacher, one of his parishioners, gave him a share of stock as a gift, and he was very appreciative. And about 6 months into this, he said, I don't want this stock, don't want any more stock. Apparently this thing had just consumed him. He was turning on the television now. So this stock market, folks, it really does create a sense of sometimes feeling like you're out of control. And as we talk about annuities in just a second, you're going to realize why annuities are gaining in so much popularity, because in most cases, the annuities we work with anyway, put you in so much more control of your money. So again, what is worth? What is net worth, and how do we define it? If you look at, let's take an example. Let's say that you own a home, and that home is worth $200,000. So again, we use that term worth. It's worth $200,000. Now let's take your 401k. Another example, you might say, well, I have a 401k, Tony, and we look at the statement, and we see that the 401k is worth $100,000. You might say, I also have 2 cars, Tony, and I think they're worth about $30,000. Maybe you get on, Kelley Blue Book or something. So now we have a home worth $200,000, a 401k worth $100,000, 2 cars worth $30,000. I might continue to ask you, where else do you have money? And you say, oh, I've got some money at the bank, and it's worth about $10,000. Okay, we add that to the mix. And finally, we find out through some fact finding that you've got an annuity worth $60,000. Now, folks, these are all called assets, and certainly an asset is worth something. But in its simplest form, okay, you have to also then ask, okay, that's on paper. That's what you've got on paper. Let's think about a home, for instance. I mean, until you sell that home, right, you don't know if it's really worth $200,000. You're estimating $200,000. So who knows what it's really worth? But we're trying to figure out your net worth. Remember, that's just your worth. Now, to determine your net worth, we have to know something or understand something called a liability. So whenever you hear the term liability, that just means something you owe to somebody else. So in this example, let's keep going. Let's say that you have total worth of $400,000. We added your home, 401k, your 2 cars, your savings, and your annuity. That totaled to $400,000. But maybe you owe $100,000 on your home. Well, we have to subtract that liability from your worth, which leaves us a net worth of $300,000. Now, a lot of people don't realize that your 401k has a liability associated with it. You've heard us talk about tax tumors. That tax tumor might be, let's say, 30% if you were to liquidate it. So instead of $100,000, really, your net worth, we have to take another 30 off that. So now your net worth is really only $270, and on it goes. So what I'm going to do in the next segment, I'm going to lay out this kind of continuum of different products, different risk, and why something called a fixed interest annuity, why this is gaining so much popularity, and how maybe we set the premise up this way. What if we could turn over our money to somebody, know that the principal's protected, and we get an interest check that's roughly, current interest rates are about 3.5% guaranteed. All right, principal protected, interest rate of 3.5% guaranteed. When I come back, I'm going to go over the timeline, and then we're going to talk about a fixed interest annuity and exactly how those work. You're listening to the Worry-Free Retirement. I'll be right back.
Are you retired or retiring soon? Can you afford for your money to take a hit with the stock market being so volatile these days? Nobody can time the market, but having a retirement game plan with Tony Walker Financial gives you peace of mind and sleep insurance. Learn how to prevent losses in your retirement accounts and plan your retirement around an income you can never outlive. Log on to TonyWalkerFinancial.com today to schedule a personal meeting with Tony to secure your hard-earned money. That's TonyWalkerFinancial.com.
Welcome back to the Worry-Free Retirement, and we're talking about what in the world is something worth. I was looking at the Dow Jones Industrial Average, and in just one day, it went up 4% one of the days in December. Another day it went down, I think, 3.5. We've been in a potentially bear market. The point is, whatever you have on paper, Aaron's got this Duracell stock he owns. We really don't know. Here's the key, folks. We really don't know what something is worth until it is converted to cash and you've dealt with all of the liabilities associated with that. That's your net worth, and then you spend it. Think about, I've got a little timeline here. I know you can't see this through the magic of radio, but think of this continuum of assets. What would be the most secure and liquid asset you could own? I'll let you think about this a minute. Somebody might say, well, my savings account at the bank. And I would say that's a really good guess, and that's way down the conservative liquid continuum. But actually, if you had a $100 bill in your pocket, that would be the most liquid and safe asset you could have. Would you agree with that, Aaron? I mean, if you were at the mall in 5 minutes and you need to buy something, the bank could be closed. They could be shut down. You may be after hours. But if you have $100 in your pocket, barring the fact that somebody might conk you over the head and take it from you, but basically that is your most liquid, safe asset. I had a gentleman the other day, and he's so frustrated with the market. He said, Tony, I would have been better off just going and burying it in the backyard. And his point was, at least I would know where it is, assuming he could remember where he buried it. And again, that he could go get it out at any time. That's what he meant. It's liquid, it's secure, and he knows what it's worth. And I said, well, quiz time. Let's think about that a minute. If you left that money buried in the backyard for 2 years, and let's say it was $10,000, okay? You just buried it in the backyard. It's still worth $10,000 on paper, but because 2 years have gone by, quiz time, is it still worth $10,000? And his immediate reaction was, well, yeah, it's worth $10,000. That's what the denominations say. And I say, no, it's not, because in that example, inflation was a cost, so the inflation ate away at it. So yeah, you've got $10,000 in 2 years. It's protected, but the buying power of that $10,000 may only buy $9,800 worth of goods and services. So here's the point, folks. There is no way, unless you're just rapidly converting things to cash and spending money as you get it, there's really no way to ever know your true worth, because we always have to net something out of that. Now, granted, if you're growing your money faster than inflation and then you're spending it, that would be the ultimate. See where I'm going with this, Aaron? Is this making sense? Matt, I think Matt is still eating oatmeal. Is this making sense to you, Matt? He's on top of this. Think about this. Because that's why people put money in the market, folks. That's the temptation, because intuitively, if you're spending money, by the time you factor in taxes and inflation and low interest at the bank, there's no way you can make it. So what you do is you in turn risk it. That would be the other end of the spectrum, and put it into stocks. Or our most extreme example was Bitcoin. Bitcoin, all this fiat currency out there, folks. Bitcoin, if you put in Bitcoin when it first came out, I haven't tracked it since, but you would have made a ton of money. Well, it's speculative. It's already way back down. So those are the two extremes, cash buried in the backyard, and let's just say on the other end of the spectrum, totally speculative would be Bitcoin. So you say, well, Tony, where are you going with all this? What does this have to do with annuities? Well, again, let's review this. There's 4 types of annuities. Last week we talked about variable annuities. We don't sell variable annuities. We don't think savers should own variable annuities because they're basically in the stock market. And then secondly, the reason most savers don't like variable annuities is because of all the doggone fees. Very, very expensive products for insurance companies to manage. So that would go a little farther out on the spectrum, a little too much risk, too high fees. So for savers, we would rule that out. You see how simple this should be, folks. What you should be doing is working with an advisor that not can help you choose investments first, but to rule out the investments you should not be considering. I mean, why would you want 4,000 options out there and 3/4 of them are probably not even suited for you? You need to get rid of the 3/4 of them and focus on the 1/4 of the options that are available, which leads us to the fixed interest annuity. That's our second type of annuity. Again, if you're just now joining us, over the next couple of weeks, we're going to be continuing our study on annuities. There's basically 4 types. Variable, we covered last week. Those shows are on the site, right? Okay. We have the podcast channel, which is very convenient. If you go to TonyWalkerFinancial.com, it's right on the homepage, and just click there and you can listen to past episodes of the Worry-Free Retirement. But anyway, fixed interest is what we'll cover today. Then you have fixed indexed annuities, my favorite actually. We'll cover those next week. And then the following week, we'll cover what's called immediate annuities. Immediate annuities, as you'll find out, are kind of like the old pension plans that Granddad was under. And then in the 5th week, we're going to wrap up all these annuities and talk about the beauty of this concept we've trademarked called the worry-free split IRA concept and how annuities fit into that. So last week, variable, today, fixed interest, next week, fixed indexed annuities, the following week, immediate, and then we'll wrap this up with an overview of how annuities fit into the worry-free split IRA concept. All right, let's do this just in the essence of time. I'm going to come back, and what we're going to do, imagine this, folks. What if you had, and we'll just use rough numbers so we can do the math real quick. What if you had $1 million in your 401k, and at least for the next 5 years, you could guarantee $40,000 a year? All right, guaranteed. We would send you that money. And at the end of that 5 years or 6 years, whatever that term is, you would still have guaranteed your $1 million. Would that be of interest to you? Well, it should be, and I'll be back to tell you how that works.
Tired of the roller coaster ride of the stock market? Let Tony Walker show you how to smooth out the ride with your money. Log on to TonyWalkerFinancial.com and let's get started.
Are you retired or retiring soon? Do you have a 401k, IRA, thrift savings account, 403b, or lump sum pension that you'd like to move to safer territory? Did you know that all the money you see on your 401k statement isn't really yours? Depending on your overall taxable income, the government has essentially a lien on your 401k that can tax as much as 40% of your money when you go to take it out. Tony Walker calls this the 401k tax tumor. For over 33 years, retirement specialist Tony Walker has helped thousands of savers worry less about money by creating game plans to deal with your tax tumor. Get control of your retirement by controlling the taxes owed on it. Schedule a free meeting to see if you can reduce your tax tumor and provide a guaranteed income you can never outlive. To get started, simply log on to TonyWalkerFinancial.com. That's TonyWalkerFinancial.com.
We're kind of ushering in the new year of 2019. You're listening to the Worry-Free Retirement. We've got some great stuff that we're sharing with you. But, you know, as I look back at 2018, not trying to get morbid here, folks, but we had a rough year. We lost 3 of our dogs. We had to put 2 of them down, and 1 of them died of cancer. 3 dogs in 1 year. My wife lost her mother, my dear mother-in-law, this past year. And quite frankly, and then Aaron lost some loved ones. But anyway, I'm ready for 2019. I don't know about you, but not making light at all of my mother-in-law's passing, but something my wife really quickly realized. The theme of this show really is, what is something worth? I'm going to get to fixed interest annuities in a minute, but case in point. All right, and this was very frustrating to my wife. My mother-in-law had some nice stuff. And so the question is, what do you do with all of this stuff? And, you know, some of it was passed off and the attorney kept a record of what kids, grabbed what, etc. And this is something you need to keep in mind, folks. If you're out there and you're a senior and you're hanging on to all your stuff, this is the real world. The majority of your stuff, your kids are not going to want. Let me repeat that. All of that stuff you've got stacked all over these shelves and buried here and there, the majority of this stuff is not what your kids are going to want. In fact, I would encourage you, depending on your age, have your kids come over. Be very nonchalant, but just say, I've been thinking about this. Is there any of this stuff you all want or you want me to keep? Because otherwise, you're going to be burdening your kids with your stuff at your passing. So what happened in Susan's case, fortunately, I have a client, and his job is to go in. He goes into estates. He does estate sales, and he does what's called tag sales. So my wife had him come in, and she said, so David, how's this work? And he says, well, what I do, all of the things you all don't take out, I'm going to tag everything. All right, so imagine this house full of stuff. I mean, I even bought, I went in there, and I felt funny buying it. I went in and bought a steamer you set in the pans. Remember those for 50 cents? I'm thinking, well, this thing, if you go over to Dillard's to get it, it's probably $8. And I don't know, it felt weird buying my mother-in-law's steamer for 50 cents, but somebody was going to buy it. But anyway, he tags everything. And he puts the tags on, and Susan's going, oh, David, that seems awful cheap. Surely it's worth more than that. The recliner, whatever it was tagged at $400. My mom just bought that last year for $1,500. Well, that's what it was worth on the showroom floor. But now a year later, Dee Dee was sitting in there, and her dog Happy's been in there. It ain't worth $1,500. So sure enough, I think that thing sold for $300. So the point is, my wife realized what something is worth on paper in reality may not be worth that at all. And that's all we're trying to warn you about, folks, with all this stuff you have, particularly if you have a lot of money in the market. It's really not real money. It's what I call funny money. Because until that funny money is converted into cash and used, you don't know what you've got. It's on paper. Not so with a fixed interest annuity. Now, we provide these. We sell a lot of annuities. We're one of the leading producers of annuities in the country. So you've come to the right place as I get ready to share with you the second type of annuity, a fixed interest annuity. So here's how it works. Obviously, all annuities are issued by insurance companies. So again, I'm not telling you if you had $1 million sitting there. We'll just use this so we'll do the math real quick. To put all your money with one company, we can divide this up. In fact, I had a large 401k client come in the other day who's thinking about doing this. And he said, Tony, I've got over $1 million. I don't want to put it all with one insurance company. Can you use more? And I said, well, of course we can. So in his case, we're going to buy a 5-year fixed interest annuity, a 6-year fixed interest annuity, and a 7-year fixed interest annuity. And you might say, well, why would you do that? Well, if you think of a fixed interest annuity, it's very similar to a CD at the bank. CDs can be purchased in 1-year increments, 3 years, 5 years, 7 years. And what the bank is saying, as well as the insurance company is saying, is if you hand over your money to us, the longer you let us keep that money in a term, let's stay with a 5-year term. So the bank knows they're going to have that CD locked up for 5 years. If you buy an annuity, the insurance company knows they're going to have that annuity locked up for 5 years. So the longer you're willing to leave that with that institution, the more interest they're going to pay. I mean, that should make sense. I mean, you got to remember they're willing to pay you more interest, so they've got to know that they can keep that money on the books. I think that's only fair. So in this gentleman's case, we were able, and again, keep in mind, folks, these rates are always changing. We're recording this show on January 2nd, 2019. If you rush and call us, these rates change all the time. So this is just conceptual, please. We can't guarantee if you call us by the time you hear this show, these rates will be out there. The best thing you can do is just contact us immediately. If you want to get some quotes on fixed interest annuities, we'll be happy to do that. But anyway, the 5-year fixed interest annuity with a good rated company was going to pay him 3.5%. The 6-year was going to pay, I think it was around 3.75. And then we found a 7-year fixed interest annuity that was going to pay 4. So in that example, we averaged them out. So let's say you had $1 million. So the average interest rate for at least guaranteed up to 5 years was 3.75. So that means, assuming you didn't need any more than $37,500, that would be the interest on that $1 million that's guaranteed for at least 5 years is going to be paid to you. Now think about this. You're retired, and this is the type of stuff we do when we're laying out a retirement plan. We're going to factor in your Social Security. We're going to look at the taxation of that. We're going to look at money that you might still have at the bank. We're going to look at other annuities. We're going to look at money you might have in the stock market or in a brokerage account. We're going to assume, if we do an analysis on your retirement, that we're going to look at any part-time income you or Martha might be earning. And then we lop on top of that in this example, $37,500 a year, guaranteed. The principal is guaranteed, and the interest is guaranteed for up to 5 years. Now, for a saver, I know some of the Wall Street people listen to this saying, well, that's the silliest thing I've ever seen. Why would you do that? Well, for a saver, this is perfect because you know you've got the mailbox money coming in from your Social Security. In this example, we still have some money over in the bank. If we had to get it out for an emergency, we got that. And we're going to be sending you a monthly amount. I don't have my math's not as good as it used to be, Aaron. But anyway, you take $37,500 divided by 12, roughly whatever that is. That's a little over $3,000 a month, guaranteed, coming in the mailbox for 5 years. Now you might say, well, Tony, how's that fixed interest annuity work? So let's take the one that's the 5-year maturity. If I want to do something different, can I take that money out? Well, sure you can. So at the end of the 5 years, it's just like a CD. That full principal, which we have not touched in this example, we just took the interest off and lived on that. Or you could actually, I meant to say that, you could say, well, what if I don't need the interest? Can I let that grow and just leave it in the account at the insurance company? Certainly you could do that, and it will continue to grow tax deferred, which is a nice feature. But anyway, at the end of that term, that's when you can take that money and do something totally different. So in conclusion, here's what I would say on a fixed interest annuity. They're perfect for savers. The rates are higher than they've been in years because they tend to track short-term interest rates. So as bank CD rates go up, fixed interest annuity rates go up. Why would you want to talk to somebody like us? Because not only can we coordinate the fixed interest annuity with the game plan, we can actually service what we sell. We've done hundreds and hundreds and hundreds, literally thousands of annuities. So we know these products very well. And being an independent fiduciary, we can shop around and try to find you a well-rated company providing a nice rate of return. Kind of in closing, too, I need to mention something. You know, I wrote a booklet several years ago called The Annuity Decision Guide for Savers. And this little booklet has been a gem for our saver clients and prospective clients. I would encourage you to download that booklet. So as we continue to go through the 4 types of annuities, again, we just covered last week the variable, today the fixed interest, next week the fixed indexed annuities, and then finally we'll do the immediate annuities. As we're covering these, it would bode you well to download that booklet now. And then as you're listening to the show or you go back and listen to prior shows on our podcast channel, that way you've got the booklet to kind of follow along. So you go to TonyWalkerFinancial.com, TonyWalkerFinancial.com. At the homepage, you just scroll down and you'll see 2 downloads there. One is called Mailbox Money for Life. You're welcome to download that for free. And the Annuity Decision Guide. At this stage, if it were me, I would make sure to read the Annuity Decision Guide for Savers. Now, if you've got an urgent, pressing need, maybe you've got a 401k from a former employer, maybe you're getting ready to retire, maybe you've got a lot of money languishing in the bank, you've recently received an inheritance, maybe you've got some old Duracell stock you're wanting to do something with. Hint, hint, Aaron. No, I'm just teasing. Now, don't get rid of the Duracell stock. I don't want that on my shoulders. That thing doubles in value, but seriously, yeah, or an old annuity. You know, that's the thing. Many of you have these older annuities that are out of surrender. A lot of these old variable annuities still charging 2.5% to 3.5% in fees each year. We can put you in one of these fixed interest annuities possibly, and there's no fees on it. I mean, what a deal. Save some of that money and put it in your pocket. So here's what you do. To meet with me in person or talk to us in person, all you got to do is log on to TonyWalkerFinancial.com. Now, once there, I'm going to suggest you click on the Let's Get Started button. That will be confidentially sent to our offices in Bowling Green, Kentucky. And then you can either meet with me in person at either our Bowling Green, Kentucky office or Louisville, Kentucky office. So do it today. Log on to TonyWalkerFinancial.com. And until next week, remember, we'll be covering one of the most exciting products that's been created in my working lifetime called a fixed indexed annuity. I'll be going over that in detail next week. But you remember, between now and then, if all else fails, you be worry-free.
If you got it, you don't need it. If you need it, you don't got it. You don't get it, shame on you. Funny, funny, funny what money can do.